Hello and welcome everyone. So it's been a while since I uploaded a video. As you all know, I have been caught up with like multiple things. So it's getting hard and hard for me to upload videos. But now I have decided that I will make a complete series with basic training from the very beginning, like how to read a candlestick to market profile, everything in detail, with keeping in mind that everything is data analysis, which you will be studying as I continue this series. So I will try to explain things in a manner that it will be easy for you to make sense of the market, not just speaking in terms of like theories, but in a mathematical way, in more of a probabilistic way, how to gather data, which data you need to do, and how to interpret the data. Like if you open the charts, you should be able to see charts in a statistical way, not like this level, that level, but yeah, but more in a statistical way. So without wasting time, I will get directly to the topic. So we will start with candlesticks proper way. One of the biggest problem is most teach and learn the patterns without understanding what an actual candlestick is. Just like you have seen a lot of videos and they all talk about candlestick, this pattern, this candlestick shape, that shape. But no one tries to understand like what exactly that means. So I will try to break that down over here. So here I will explain how to read a candlestick as if it's a data point and connect it in a way you understand it statistically. So how it's no, so what is it and how we reach the candlestick? So as we know, the share market is roughly 500 years ago. It's very historic. Like 500 years back, people still used to understand the charts and stuff. So how did people trade or anything without candlesticks? So when it was well back then, it was only limited to few people. A lot of people didn't even know like this thing existed. So it changed a lot, like any other thing over the world with the printing press. So when printing press started, newspapers and all started showing the prices. So before, like this is one of those times. So it used to only show the closing price of any share or any metal, anything that is to be traded, only the closing price. So that's how price were and always showing closing price, latest price. So it's the closing price of the day. So then it changed and started showing the percentage change and the closing price. So today's closing price and like how much did it change from previous day's closing price. So that gave you the context of like how much the share has grown or any asset has grown in like last 24 hours and so. Then it became like open, low, high, close, and change. So this is what we see in our terminals and stuff: open, low, high, close, and change. This is it is a new thing which has been in trend as of now. But this is on a day. But with computers, this turned it like even further to 1 second and other stuff. So second, 30 milliseconds and all that stuff. Like computers, like it computes very fast. Like every second you will get open, low, high, close, and the percentage change. So it become way faster with computers. So candlestick existed long before computers were formed. So let's understand like how did we reach the candlestick, not just in terms of like the chart patterns and stuff, but how exactly the data is interpreted. So why this chart and like so what form of chart is appropriate for this kind of data, like open, low, high, close, and percentage change. So this is just data points, right? We are given four numbers and a percentage change. This is just data points on a day. So which chart pattern or like chart form is crucial for this? So there are pie charts and different stuff. So why the candlestick chart, how it came into existence? So whenever you look at x-axis or at a chart or candlestick chart, you will see x-axis and y-axis. But why this? So when you see on x-axis, we start from zero and we keep going on. So axis is continuous. So like there's no proper definition of like how much price can move in given candlestick or given time frame, 1 minute, 1 second, 1 hour. Like there's no fixed amount of for price movement. So it's called continuous. It can be 0.5, 0.25, 0.1, $1, anything. It can be anything, and it's continuous. It's not well defined. So that's why x-axis is continuous and y-axis being discrete. Discrete as in like if you pick anything, like even the temperature thing, temperature on x-axis can be anything, 27 degree, 35 degree, 48 degree, it could be anything. But on y-axis, we have to define it. Like, is it the temperature of Mumbai or Delhi or any other place? Or like if you are doing it like 9 p.m., 2 p.m. temperature, so the same graph, so you have to predefine the y-axis, that discrete. So in candlesticks, we define it as like a time frame, like 15 minutes candle, 30 minutes candle, and so on. So it's predefined, and x-axis is not defined. There's no such thing as this will move this much only. But on y-axis, it's predefined. On x-axis, we do a lot of analysis, like averages, average movement and stuff. And this is very important as of now. It might not make sense, like why I'm explaining continuous and discrete. But when you get into data analysis and try to read everything in statistical manner, this becomes very important. So we will get back to that in the later sessions. But okay, so if we use only the close price, how would a chart look like? So closing prices over here, next to here, here, and here. So, so this is a normal graph, how it would look for this closing price chart. So this is how a lot of people did analysis. You can see continuously moving down, so a downtrend. Normal graph, right? You can see the closing price moving down and simple and clean a down. So now if we use open and close price, how would candlestick chart look like? So this blue one is the closing price and this one is open for one time frame. So you can see the close is above and the open is low. So it means it was bullish. And this one's close is lower and open was high. So what does that mean? It's a bearish candle. And likewise, same thing. Closing is lower and opening is high. So again a bearish or like say bearishness or say a downtrend or a down candle, whatever you want to call it. So what if we overlap this one? So open is lower and the close is high. So you can clearly see over here, this looks like this. But in this case, where the open price is much higher and the close price is lower. So if we overlap it, it is completely engulfing this candle. So it wasn't very appropriate, like putting the open price behind and sorry, open price next and closing price is behind. In this situation, if you do that, it's completely engulfing it. As you can see, this has completely engulfed this, and you can't see or can't make sense of the data anymore. So what did we do? So again, this one will just look like this. And wherever it overlaps each other, how about we color it with a different color and the pink one. So this is this overlapping area, which wasn't visible because we used a different approach. Now, whatever part is overlapping each other, we will just paint it different color. But now, as we know, like we have four data points, open, low, high, close. High and low, by default, high is higher than the low. So yeah, that we made it a wick instead of another color. We just marked it as a wick or let's say thin line. So this is how candlestick is formed. And this is very important because like this might be looking as an SFP, but like in terms of data points or like say open, low, high, close, nothing more than four data points, four numbers just arranged in ascending or descending order, whatever, however you want to read ascending order. So like low, um, open, close, and then high. So yeah, you will get a candlestick. But you have to understand this are just data points, the patterns and all those things that come later on. I will explain it how to read it and all the stuff, but you have to understand these are just data points. How I mark all the HHRs and the gap fills and all that stuff. These are just data points which will help you get more and more data or like data analysis points. So now we know it's just four numbers that are arranged in ascending order based off open and close price respect to each other. The color is decided as I have explained it. So now we'll build on top of this. Before we jump into data collection part, I will introduce you to some perspective that will help you read and understand what a candlestick is saying. Yeah, this is one of the most crucial parts, uh, how to read a candlestick. So I will take an example, like instead of like jumping into stock market, how about I just use some random example from in real life that have exact four data points instead of like price points. Price points are just data points like one, two, three, four price points. So I will take some real life scenario where we have exactly four data points and how do I read it, or like how to read any given four data points. So let me switch it to a different screen. So let's just say you live over here and this is where your friend lives. So let's just assume like your friend calls and says he wants like 10 kg apples or something and it's urgent. So what do? You're at your home, right? The first thing you're gonna do is like, yeah, your friend lives here instead of, and let's just assume like there are two shops where you can get 10 kg apples. It's this place and this place. So by assumption, like uh, okay, you have to go to your friend's house by taking 10 kg apples, right? So first thing you're gonna do, like it's here, the shop is here. So basic approach would be like, how about I buy apples from here and then go back to the house. So you start from your house, you go back over here and then come over here, and that's the final destination. In that case, this week won't exist because you didn't travel this path at all. So, but in the scenario, what I'm trying to explain is you moved from here, then you went over here. When you reached here and you realize that there's like shortage and there aren't 10 kg apples here anymore. So your second option is go back to the second shop and buy from here and then go back over here. So in this scenario, what you will do, like you will move from over here and then go back. The drawing is so hard in this. You will go back to the shop, buy some apples, and then move back to your friend's house. Here, like clearly we knew like we gonna go over here and if not over here, then we will go back here and then we will go back to our friend's house. So whenever you see me trading or share daily plans and stuff, I try to figure out these 4 points, like where are we currently, where is the liquidity, or like where we can fuel or we can get rejected. I mark this places out and where we are trying to go, or like where is a lot of liquidity or where price is getting accepted. So I will explain these terms, but the whole idea about data analysis is this, like you have to figure out where there could be a rejection, or like where we will grab some orders and stuff, and then where we are trying to reach. So basically this area, or like this is place where we want to go, this is what I call mean reversion, and those are like value areas, highs and lows, or like order blocks and stuff. So it's like normal life example, like how a person would go from two shops and then reach a friend's house with all the orders and stuff. But in stock market, same thing, we have to find out where the liquidity is, like where we can get our orders filled. And if it's a mean reverting market or mean reverting conditions, where is the mean, or like where is it getting accepted? The whole point is like find out these points where we are getting liquidity, and if it's mean reverting, where is the mean. So this is exactly how the whole data analysis revolves around. So you have to focus on getting these points right and this one. Rest everything in between is noise. Don't try to get involved anywhere else. So just in case, I will explain how I trade. So let's just say started from here, we went over here, and then we started moving here. So this point is where I should be looking at all the order flow stuff, the Renko, the chart patterns, the CISD and all that stuff. So here Renko would be looking like something like this. Okay, so this is where I enter. Like Renko is showing me like, yeah, it is getting rejected over here. So now I play the mean reversion and target over here. First target would be this. I don't know like if I got 10 kg apples or not, but as it's mean reverting, I know at least it will reach over here. So if like price will hold over here, then it will go over here. Again, I will look for Renko chart or something again over here. Here Renko would look like something like this, and I would enter over here, and then this would be my target. So this is how I operate everything. Here you have to look for absorption and stuff. Same thing here, absorption and stuff. Or like you can use the chart pattern CISD, like price has moved. And this is the last bearish candle or like last opposite side candle, and if it's breached here you would enter. This is a CISD, again same thing, price move past this, and then like this is the last opposite side move over here, and price tries to move, break it, and I would enter here. CISD, Renko, absorption, all are important. Like this will help you make an like more sensible bet than taking some random trade or like this simply based on Renko. So Renko and all that stuff I want to see over here. So your first job would be like find these areas, and like this is mean reverting market, so you have to find the mean and the places you would be interested to sell. All the trades I take are based off this. So I have to find these points where there would be a rejection. I don't know like if it will indirectly rejected reject from here and come here, or like keep on moving here and then come back. I don't know, but I'm still simply playing a mean reversion till over here. If it gets more no rejection, then I will continue to play the mean reversion to the other end. Then if it's getting rejected over here, I will probably play again. This is the whole thing which I use in my trading strategies. The whole data analysis, all of whatever I will be sharing further down the series will be around like how to find this points and this point. So I hope you understood like what I'm trying to explain. Now let's get back to the candlestick. Right, so I hope you understood with that lame example from in real life, like just 4 data points you need. Candlestick patterns and all that stuff will help you make a better decision, but those are just data points at the end of the day. You have to understand the patterns are there to help you make a better decision. They aren't everything you need, but they will help you make a decision. You have to understand the mean reverting, where the price is getting rejected or where it's trying to go. That's a completely different story, which your patterns won't help you. So we have to keep both these things differently. There are many people who try to explain as if both are the same, some holy grail stuff. There isn't any. You have to understand the sentiment and all the stuff. We'll cover that in the future videos. But I want you to understand like how the whole thing works, which I try to explain with some in real life example. So candles is everything? No. Just revolves around 4 data points, that's all. Over the years, people made different observations and they traded. Obviously, same thing which I do. Like I try to figure out the points where I would be looking to trade. And if there's some reaction at that point, I will enter. If not, I will just patiently wait. So same thing, all these things like candle, bars, hollow candle, volume candle, lines, this area and all that stuff. Then this comes like volume footprint, TPO, session, volume profile, Heikin-Ashi, Renko, point and figure ranges. You have to pick one or two, or like just one is fine. But what I prefer is candlesticks, footprint, and TPO and Renko. This four like I pick this four because like this four complement each other. Like you have to find middle point or like places where like these two have something in common. Like CISD and Renko, they both complement each other in such a beautiful way. That's why I have a mix of both when I'm trading. And with volume and footprint, this helped me find those points where like I said in the example which I shared, like where to look for ejection and stuff. Footprint and TPO help me find those points, but Renko and Candlestick help me decide how to enter and when to enter. So these two combinations which I use with these 4 types of dots is everything I use. So this is just TPO. It gives extra information instead of just like if you just look at it, open and close is there, high is there, and low is there. You have everything which a candlestick has: open, low, high, close, everything is there. There's an extra information like where the price has spent more time. I will cover it in detail, don't FOMO it as of now, but like it's just extra information. Extra information is always better if you know how to read it. So I will explain that in further. Renko is like just same thing. I know like if I'm bearish on certain day and if I see a Renko chart, okay, cool, it's getting bearish, so I will enter it, and that's all. Same thing like a size matters, like a size, Renko size and stuff. I will come cover that in detail in future. And same thing, footprint, like where the orders are being absorbed or like getting rejected, it helps me with that. So you have to pick one or two or like four or six, whichever, like they have to complement each other. Like candlestick and Renko complement each other. Footprint and volume, sorry, TPO and footprint, they complement each other very well. So you have to make strategies which complement each other. So for now, this is the introduction part, and I will slowly cover all of them in detail one by one. Hope you like the video, and yes, do like and subscribe for further videos. That's it for now.